Recently, Saurabh Mukherjea invested in GoDigit. Today we are going to analyze what he saw in the stock and if it can be a multi-bagger. As you can see from the charts, the stock was listed at around 280 and currently is at 370. On the first day of trading, the stock witnessed a massive volume of 54 million shares being traded. However, since that day of trading, the volumes have been absolutely dead on Digit's counter. Even after low volumes, the stock has managed to move up from 280 to 370. We can also see that the stock has been on a clear and steady uptrend. From the charts, we can also spot a resistance near the 370 to 380 levels. For fundamental analysis, we will be using screener.com. Let us move up to the top of the page and read the basic details about the company first. The full name of the company is GoDigit General Insurance Limited. As you can see, the company currently has a market cap of rupees 34,000 crores and a PE ratio of 188. Let us now come to the About section at Screener. The company was established in the year 2016 and offers various insurance products such as motor, health, travel, etc. Personally, you might have heard about their car insurance or travel policies. They are quite popular these days. As per the data in Screener, the company has seen rising market share and held 6% market share in the motor insurance market as on December 2023. The company has 43.3 million customers and has gross written premiums worth 6,679 crores. The company also has an amazing customer retention ratio of 85.5%. The company also invests its premiums and investment income for last year has been rupees 776 crores. All these are quite interesting data points. For an insurance business, there should always be a very well-functioning investment wing which generates decent returns. Many of you would not be aware that Warren Buffett's Berkshire Hathaway is also in the insurance business. Digit is one of the first non-life insurers in India to completely pivot to cloud operations. When you see the product-wise contribution to insurance revenue, you will see that more than half of Digit's revenue comes from car insurance, followed by property and health. Digit General Insurance spans 24 states in India, collaborating with 61,972 distribution partners. Additionally, they sell products directly to customers through its website and via web aggregators. Coming to the investment division, the company invests its cash flows from insurance into Indian securities. These investments generated returns of 7.4% during 9 months ended 31st December 2024. The majority of investments are in risk-free securities like government bonds or low-risk corporate bonds. It should be noted that Maharashtra, Karnataka, and Delhi account for more than half of the revenues in the insurance segment. This means the company's penetration in Tier 2 or Tier 3 cities is not yet strong, and there is a massive market yet to be captured. Please note that the company's PE ratio is the highest among peers. This does make the stock risky, but considering the unique business model, revenues will boom at an exponential pace compared to peers. Now we come to the financials. As of year ended 31st March 2024, the company booked revenues of 7.3 thousand crores and profits of 182 crores. Honestly, for a tech-based startup like Digit, being profitable is in itself a huge task. However, we can't ignore the room for more profitability. The major portion of expenses are coming from the cost of sale of insurance. The company should focus on selling more and more policies through its app rather than through agents. This would increase profitability remarkably. Please note that the manufacturing expense shown in Screener means cost of revenue. The company's high PE ratio can be justified only if the company works towards improving profitability. If the company is doing so or not could be understood by going through its annual report. Now coming to the cash flows, as you can see, almost all of the company's insurance business cash inflows are being invested. While reading about the company earlier, we had seen that these are mostly low risk, low return government bonds or corporate bonds. You could expect these investments to yield around 7% annually. The company's return on capital is 7%, which is weak. This, if you notice, is same as the returns of the investing division. This means that the insurance profits are virtually zero. This can be improved by increasing profitability. Coming to the shareholding pattern, promoters own 73.5% of the company, which is a great thing. Specifically, almost all of the holding of the promoter group is through a private company named GoDigit Infoworks. FIs and DIs also own a significant portion in the business. The DIs include Mirai, TVS, and Faring Capital. The confidence of institutional investors in the business is also a green signal. Many of you would be excited to know that even Virat Kohli has some stake in GoDigit and invested much before it went public. He is also their brand ambassador. Now comes the important question. Is the stock a potential multi-bagger? I would say yes, but there are a lot of risks involved. If the company does not actively start cutting costs and try to move its revenue source towards online apps, the stock would move nowhere. The profitability needs to improve by a lot. However, the way in which the business has turned profitable in such a short time is remarkable. I do like the stock and might be interested in buying. But before that, we need to understand the management's plans with the business by reading the annual report. I would make another video summarizing what I learned from the report. Subscribe to Indie Accountant to stay tuned. Also, like the video and comment your views on the stock. Thank you.